Welcome you all to the Daily Energy Markets podcast. It is April the 22nd, Monday, Dubai here. For our Dubai residents, we're out of the floods and we're back to normal, which is good to hear. I'm delighted to be joined by Omar Najia, Global Head of Derivatives, BB Energy, Kate Durian, MEES Contributing Editor and Non-Residential Fellow at the Arab Gulf States Institute in Washington, and Victor Yang, Senior Analyst, JLC Network Technology, who for the time being is off camera but has joined us. So thanks everybody for joining us. And what a week it's been in so many ways. Omar, let's start with you for your start of the week sort of analysis of where this market might be going, a bit of a review of what happened last week. Oil prices have again kind of calmed down a bit. They didn't move, they moved and they've sort of settled. Your sort of viewpoint of where the trajectory is going.
So basically, we think market's trading about $81 plus or minus on WTI. As long as that market stays above something like, not something like, but exactly 76.80, then we think we're going straight back up again. So we think basically, if you look at a chart of WTI, you'll see that this upside move started on the 13th of December from 67.76. It reached a high on the 12th of April at 87.56. So what's that? $20 plus or minus a barrel. And then we've moved from that high at 87.56 down to about $81, where we are plus or minus today. So as long as this market stays, let's call it 77, then we think basically this market will come, set new all-time highs. We think oil is in a big, long-term, lasting years uptrend. We think the same for equities. We think the same for Bitcoin, and we think the opposite for the US dollar. So we think that inflation will continue. We think the Fed will continue to spend. We think that they will cut interest rates because it's not really the Fed. It's more treasuries, and they need to sell debt. And they need to pay for their debt, so they'll reduce interest rates and keep the heat on the markets in general. So we are bullish markets.
Okay, thanks, Omar. Kate, I mean, reduce interest rates, that is obviously a long-term game anyway. This year, we're having a little bit of retraction because, you know, we still see the US economy doing okay. And so the Fed's in a bit of a pickle as to what they should be doing, having planned to start cutting. And now we're seeing some hesitancy on that. But again, just from sort of an oil market point of view, Kate, I mean, one of our headlines this morning is, you know, growing hostilities in the Middle East cause significant volatility. Apart from the long-term trend of upwards, which is a long road, do you expect that we're going to see more volatility this year with, you know, given the geopolitical context and also the demand projections that we're seeing from the main consumers?
I think we are going to see more volatility because nobody knows what's going to happen next. But, you know, if you look at what's happened over the past few weeks, it's almost like a chess game. You know, if you look at a chessboard, there's a lot of pawns in the game, and you've got the sort of the main players who are, you know, it's sort of like choreographed attacks. But again, I think one of your guests a few days ago was talking about this. You've just got so much firepower in the region that anything could just, you know, escalate it. But for now, it looks like the main players don't want to escalate matters. But if you look at the policies, you know, yes, you get signals from the United States that rates aren't going to come down anytime soon. That puts the Europeans and other countries that are sort of that follow the sort of US in a pickle as to, you know, when and how to cut rates. So it's a bit of a difficult situation. But looking long term, I mean, we're getting in this part of the world, forget about the rain and the floods in Dubai, we're entering the sort of the high demand season in the Middle East. And if you look at the IEA's forecasts, they're actually expecting the Middle East to be one of the main drivers of oil demand growth. So I think it's sort of a mixed bag. We've seen prices come off because, you know, as I said, it is a game. It's sort of all choreographed. But there is still that potential of, you know, those proxies in the region sort of escalating their attacks and then getting pushback. So, you know, it's not easy. There's a lot of countries that are sort of indirectly involved in this Middle Eastern conflict. So the prospect is probably for more volatility.
Okay, thanks, Kate. Victor, welcome. Let's get your point of view from China now that it's done with its first quarter. The economic outlook there, I mean, I'm feeling slightly more positive vibes than I felt 3 months ago about the commentary, at least, coming out on China. Give us your point of view of where you think that's going in the second quarter, and really in terms of for the year ahead, are we expecting to hit economic targets?
Yes, well, the sentiment is now better than early this year or at the end of last year, as we see the expansion in the industry and growth of 1.3% in the first quarter. And now for oil demand, say, for instance, gasoline and jet fuel demand has been growing, particularly gasoline and jet fuel at the beginning of this year. And we expect another surge in around the coming holiday in the beginning of May. So for gasoline and diesel, and average consumption is picking up quite significantly. But for some other products, such as diesel, it's not picking up quite significantly yet. So products are doing quite differently. But overall, the sentiment is better than before, and confidence is picking up. So we expect the country to achieve its growth target of about 5% this year.
And Victor, just to keep on with you, just to sort of see in the context of what you've just said, how's that impacting imports of crude oil for inventory stock, and how's that doing in terms of inventory indications and or for consumer demand? We have a headline again saying that Russian oil imports reached record highs in March into China. Generally speaking, the outlook for crude oil imports in Q2.
Well, the country's crude imports grew by 0.75% in the first quarter, but imports from Russia surged by close to 13%. And in March, imports from Russia actually took a record high share, over 22%. And when we see why China's crude imports are growing, we see that demand, say, for some fuel, gasoline, jet fuel, is still growing. And the country's refining capacity is on the rise too. But we are seeing much slower growth in 2024. As we mentioned just now, 0.75% in the first quarter. This level is slow now. And we do not expect growth to be much larger for the whole year when crude prices are high. And domestic fuel demand is not growing as fast as actually its production yet. So we expect kind of modest growth for the whole 2024, about 1.1%. And for the second quarter, we see a lot of refinery maintenance is imports could actually come down. And for now, the premium for Russian cargoes had strengthened this year. They from minus 0.5 barrels per day barrels to minus 0.3 per barrels, and now it's flat to Brent. I mean, it's zero now. So this has dampened refiners, particularly independents' interest in Russian crude. Their margins for imported crude, including Russian crude, actually turned negative late last month and the beginning of this month. So it's now kind of positive, but still just slightly above the break-even point. So their interest in this has been dampened too. So we are not expecting imports to grow much in the second quarter. Yes.
Right. So we've seen the high of that. Thanks, Victor. Omar, just back to you. We have another headline on our news bulletin about the US. I don't want to get too deep into the politics, but passing oil sanctions on Iran again. Now, a lot of people have said that'll make absolutely no difference. In the same time, last week, we didn't have the Venezuela oil supply renewal reprieve, etc. Is the market, are traders paying any attention to sanctioned oil in this context that you described in your earlier comments?
So in a word, zero. So the US did the sanctions. We were told that, oh my God, what they're going to do. Then we were told that they're going to put the European or the whatever it is, the $60 price cap. Oh my God, it's going to be terrible. It's going to really, whatever. And the market reaction is, so basically they failed. They will continue to fail. Nobody's paying attention. It's like children playing in a sandbox. Like, we're going to do this, we're going to do this, and soon we'll rule the world. And nobody's paying them a bit of, a blind bit of attention. So they've sanctioned Russia. They can't do more, but they keep coming up with the 17th, sanction thing. They've sanctioned Iran for the last, I don't know, 50 years? And they're still sanctioning Iran. They've sanctioned Venezuela for the last, 20 years? And they're still going to do more. I mean, it's a joke, right? They can't. This is showing you that there's nothing else that they can do in terms of quote unquote sanctions. We've reached the end of sanctions. They failed completely and, probably never to be seen again. But yes, nobody, they're not going to do anything. Iranians don't sell their oil to Europeans or Americans. Same with the Russians, yet, they sell plenty of oil. So no, we don't pay attention to these,
Okay.
more sanctions and all this kind of
Not
stuff.
going to
No.
make a big difference. Even the strictest sort of shipping sanctions that the US brought on in the new year. Kate,
Oh,
let me go to you. We have in terms of sort of OPEC. Let's talk a bit about price projections from OPEC, and also I want to get your opinion on whether you think we're going to see these diversions on oil demand growth that we had from OPEC last year, IEA, EIA. Is that narrowing, and why? And also, what action do you expect OPEC will take in June? A few weeks ago, it was like, oh, they're going to definitely start cutting, reversing some of their cuts. There seems to have been a bit of a pause in that sentiment last week. Again, how do you think they're going to be looking at the second half of the year?
I think, it's very difficult to tell what they're going to be doing, but also, how it affects supply in the second half will depend on how they taper, if they decide to taper these cuts and sort of bring some supply back. But, there's a lot of supply coming from non-OPEC plus. So I don't know, if you look at the average of where most people see demand going, I mean, OPEC is the highest at 2.2. You've got the IEA now has reduced its demand outlook again by 100. So basically, we're back where we started 2 months ago, 100,000 barrels a day. It's, you've got the EIA, you've got other people saying 1.9, big trading houses. So I think, if you put an average of, say, 1.5, 1.6, a lot of it is going to be met by non-OPEC plus. So it's going to be very difficult for them to decide whether they taper the cuts and then, push prices lower because there's a lot of supply. As Omar said, the sanctions aren't really going to have that much of an impact. So it'll be interesting to see whether they decide to sort of taper it gradually, bring back some of that 6 million barrels a day that's off the market. 3 months here, 3 months there, because that will have a huge impact, and they'll probably try to do it because most of the demand we is sort of behind us, really.
Okay, thanks, Kate. Victor, just back to you on China again in terms of government policy. You talked a bit about what the forecasts are for oil imports. Give us an update on where the stimulus program stands now in the second quarter. China got a lot of criticism last year for not doing enough. And not doing things too soon in terms of stimulating consumer demand in any way it could have. We know the property sector is still in trouble, but otherwise, what is the outlook for more stimulus measures for consumers and bringing confidence back to them?
Well, one of the ways to stimulate consumption is, say, for the coming holiday in May. At the beginning of May, we actually had just one day off from work, but the government make it 5 days together with the weekend, and then we had to make up for 2 days. So the government made it a 5-day holiday. So to get people to travel and to spend, yeah, that's one of the ways. And some people do not like it. But as for other spending, I mean, consumption stimulus, well, there's not such a strong stimulus as, say, a few years ago. And the government is just mainly focused on the spending of average people at the moment, not to stimulate some industries as robustly as before, as now trying to push for industry upgrade. So it needs to strike a balance between these stimulus and its industry upgrade. Say for exports, for instance, the government is under, say, Chinese oil refiners are under pressure to export more oil products to give a boost to the economy. But at the same time, the government is under pressure to achieve its emission targets. So it needs to strike a balance. For the last quarter of 2023, Chinese oil companies actually hope to boost their exports, but they didn't. They failed to do so as the government, well, didn't release more quotas on that. And for 2024, it might have to release more quotas to give its economy a boost, but not sharply more. So, yes, that's all.
Okay, thanks, Victor, for that. Almar, let's get your take on Europe. If we can just zero in a bit on that again, like summer demand. I mean, jet fuel had a recovery and a continued recovery last summer ahead of summer travel. I'm sure the same is expected this year. But would you say the sentiment for that, and how is that impacting the cracks for products like jet fuel versus others for industrial action in Europe as we go into the second quarter?
Well, so the markets are seasonal. So if you think that demand is going to go up because of we're going into the summer and all this kind of stuff, and jet fuel because of holidays, then yes, but everybody knows that. So it's not really giving you any kind of edge or view to trade the markets, right? If you're doing what everybody else is doing, then there's very little point. So yes, markets are seasonal. Demand for certain products goes up at certain times of the year, and demand for other products goes down at certain times of the year. But I mean, what we like, or what I like to focus on is the big picture. You either believe that this market, like all other markets, because oil is not driven by supply and demand, whatever people tell you, because it's a financial market by a mile. You have to look at other markets, and you have to think either all these markets. The only way oil is going lower is basically if we have a massive recession everywhere. So are you a believer that we are going to get a massive recession? Because oil is not going to come off if the S&P goes up. S&P isn't going to come off if Bitcoin goes up. Bitcoin and the S&P aren't going to go down if the dollar goes down. So you have to have a view that's basically broad and take a view of the oil market based on that, or at least that's what we try to do. But whether demand for jet is going to go slightly higher or slightly lower.
What about the fact? Okay, what about what the S&P and Bitcoin will do versus gold? Do you think they will rise together, or would gold be seen as
gold is very interesting. Gold basically is a market that was also financialized. So basically, most of the trading that happens in gold happens on paper. It's not deliverable. You can't buy gold futures and take delivery. It's financially settled. So gold has gone the way of crude. Crude, you can still get delivery, but for retail investors, forget it. So gold basically has quote unquote lost its luster. If you were to buy real physical gold and keep it in a safe or something like a kilo bar, then great, it's going to go up in value. But if you want to buy like futures and stuff like that, forget it. So the new gold is Bitcoin, which is digital gold, which is physically, although it's a virtual thing, it's actual physical Bitcoin that you're buying. And today is interesting because the CME trades paper Bitcoin. And those paper Bitcoins, according to the close on Friday, are underwater. I think the market closed there at about, 63,000 or something. Market right now is printing real Bitcoin is trading at 66,500. So I'd expect a nice pop come the US Open. But the main point is we are in an election cycle. Election cycles are inflationary. They are not deflationary. Even though the US government want oil prices as low as possible, they have lost control of oil markets because a lot of the oil producers basically have now joined BRICS. It's the first time in history that that's happened. Oil, by historical standards, compared to Coca-Cola or Evian or burger in McDonald's, is extremely cheap.
Okay,
So
thanks, Omar. Kate, I'll go to you to ask you after we get the survey question out on whether you think the US has lost control in terms of how it can influence oil markets, both geopolitically and practically, with its own supply, if you like. What will have the biggest bearing, a question today, on direction of oil markets through Q2, the remainder of Q2? Is it going to be geopolitics, higher for longer rates, OPEC supply cuts, or the China economic outlook? Very broad question there. We've addressed, obviously, also what might or might not happen with rates and supply cuts from OPEC already and China. But what do you think is going to have the biggest bearing, Kate? Because we still see this risk premium very much under control from a geopolitical standpoint. But do you think the US, through sanctions or through oil supply or through its geopolitical relations, has lost control of how it can influence the oil price?
I don't think it's lost control as such, but if you look at the latest package of aid to Ukraine and to Israel and to Taiwan, I think is one of them. It's very difficult to see. It's not as if anybody is trying to end hostilities that have actually had an impact on Ukraine, initially on gas prices and oil prices, and now the Middle East conflict. So I think geopolitics is I think the geopolitical risk premium is already baked in unless something really major happens. I would think that Chinese growth is really going to have the most impact because, we know where the supply is and we know where the supply is coming from. And I don't think OPEC cuts, if they do come, I mean, Mies had an article a few weeks ago sort of calculating how much of a difference it would make, how they taper these cuts. But I think, given that there's so much supply coming from non-OPEC plus, I think China is probably, if I could choose two, I would say, rates and the impacts of higher prices on inflation and the Chinese economic outlook, because that's really the driver of the oil demand growth.
The swing demand. But Kate, just sticking with you, you mentioned there, unless things get much more, escalate in the region, of course, the big if, and we're seeing signs of it, and who knows when it might or might not escalate. But I mean, again, for a market that could be very vulnerable to that escalation, it's really, there seems to be a big belief that things won't. I mean, are we being very complacent here?
Well, I think the market has been complacent from the very, very beginning. It has responded sort of a little bit to events that, sort of signs of escalation. And then it was sort of like, okay, yeah, it's happened. It's over. No major damage. We're back to the shadow war between Iran and Israel. Ukraine is more interesting. If this aid prolongs the war, if you keep getting attacks on infrastructure, Russian infrastructure, it's going to have an impact on products, because at the end of the day, we're not using crude oil, we're using products. So if that has an impact, we're already seeing, strains in supply chains. The attacks in the North Sea, in the Red Sea by the Houthis aren't going to end. You see this sort of, a lot of Lebanese people I speak to are so concerned that Israel might retaliate against Lebanon at some point. You've got hundreds of thousands of people, both in southern Lebanon, northern Israel, who have to return home. So at some point, that situation has to be normalized. So, there's a lot of loose ends at the moment that you just don't know. But I think the geopolitical risk premium is there, but it will depend on how, we go from here, whether it goes, back up to 90 and above. Some people are predicting that prices will go up, and, second half, we might see prices above, 90 creeping up towards 100. So it's very difficult to see. It actually makes it very, very hard because, the impact on demand is really the key, and it's been demand has been the driver. I know Omar talks about technicals and the fact that it is a financial market, and that's partly it. Is it going to be seen as a safe haven? Because if you look longer term, I mean, I keep looking longer term, and the way things are happening, governments pulling back from the sort of climate targets, so that is going to have an impact longer term on oil demand, I think.
Yeah, yeah. And I mean, I suppose, you know, we've got very steady. I don't think we're going to get any major surprises on demand for the rest of this year. We're already, you know, seeing what, and as you said, and Amar said, it's an election year, so everything is going to have a tendency to be pushed economically, at least. And the IMF there thinks that Saudi Arabia needs an oil price near 100. That's another article we have today. So we'll see what happens there. Victor, just back to you. We had one or two comments last week, just again, sticking to geopolitics a bit and China and demand. And just give us your perspective on, you know, last week we had someone saying Iran's actions, all it cares about is what China thinks, because actually that's where its oil is going. And so how much do you think China is weighing in on any of what's happening in the Middle East behind the scenes? Can you, even if you don't know, would you say that there'd be an interest in it doing so, or is it going to continue to take a back seat from what appears to be the case? And does it care?
Yeah, I wouldn't say it take a back seat, but it's not meddling so much. I mean, it wishes for peace in the Middle East. It does the country good too. It needs a stable international environment for its development. So it is trying to bring peace. I mean, to get both sides to talk to each other. And he has been making efforts to, but those things is doing more than that. Is just kind of trying to get them to talk to each other and bring peace to the region. And this is conducive to the country's development too. Yeah.
What's the latest in the trade disputes with the US as well, that we seem to have seen those calm down a bit the last few months? The sort of tit for tat, slapping on different tariffs on technology, etc. Any outlook for that from your point of view?
Well, this will continue, I believe. It might cool down a little bit before the election to some degree, but this is a long-term trend, and the U.S. government, the antagonism towards China will not change much. So this is not expected to change dramatically.
I guess we have also the election year, don't we? We'll see what happens when Trump, if he comes back. There's the result for today. Very close, really. Gosh, 29%. So pretty balanced. All of the above really is the answer there. And in practicality, it probably will be. Omar, let me go back to you again. We have it's peripheral, but we have a headline, again, bulletin today on our news bulletin about AI and big data and trading, commodity trading. Are you in the camp that believes, along with some of the bigger trading houses, that this is going to make a difference? I mean, obviously it is going to make a difference to certain sort of models, but you know, is that something to pay attention to? Do you think, will it make any difference?
No. So basically, the only place that they use AI and high frequency trading and all this kind of stuff is in the US equity markets, where they use it basically to rip people off. So what they do is they see all the orders coming in, and the AI buys in front of those orders. And when the orders come in, they resell them back and they make a tiny bit of money, but they make a tiny bit of money a lot of the time during the day and all through the year, which is why real estate markets in places like New York that are close to the exchange cost so much money, because that gap of like 0.7 or 0.2 or 0.1 seconds gets you to front run markets. So no, in terms of, I mean, you have to understand all this AI stuff is the stuff of rule following. If this, then that, and you know, you do it over and over and over again. It's like the robots that clean your house, right? I have, I think, 6 of them, and every now and then you get like, oh, robot is stuck. Oh, robot's wheel just fell off, and this kind of stuff. So yeah, honestly, I don't think. I mean, you know, we were promised driverless cars by now, right? And that's not going to happen. That's not going to happen for a long, long, long time. So let's watch and see. But
Okay.
no, I'm not a believer in AI trading commodities. No.
Okay, thanks, Omar. Kate, we've just about run out of time, but just to go back to, you made a comment at the end there about you know, obviously long-term demand, energy transition, renewables, etc. We did have some headlines last week out of Scotland, sort of retreating on its net zero targets. We've had companies like Shell and BP begin to say, okay, hang on a minute, actually, we're going to continue to focus on conventionals. And so this retrenching of commitments is becoming more pervasive, isn't it? Is it because of geopolitics and energy security, or, was this inevitable?
No, it's the bottom line. Shareholders want to see returns, and I think in times of crisis and in times of inflation, you sort of think, do I really want to see, who's going to pay for it? It's still, renewable energy might be cheap to install, but at the end of the day, it has to be subsidized. So I think it's really the bottom line. They're looking at the bottom line. They're saying, we're not making much headway. So I think that's really what's driving it. And also the realization that they're going to miss their targets anyway. So, you look stupid if you set your target, you miss it. You set a higher target, you miss it. So I think it's being realistic about the pace of the transition and the fact that we are still going to be relying on, oil and gas for a long time to come, not just for transportation. That may come down, but, demand for transportation might come down. But in other areas, I think we're still very heavily reliant. So I think it's that realization that renewables just can't meet that surge in demand immediately, and it's going to take time to scale up.
Okay, thanks very much. Thanks to Kate Durian, Amar Najia, and Victor Yang. Thank you for joining us, even if it had to be off camera today. Have a good week, everybody.
Thank you.
Bye-bye.
Bye-bye.